For decades, the global economy operated on a single, unspoken rule: property values only go up. But right now, the single largest asset class on the planet is doing exactly what it was never supposed to do. It is falling. Look at Chinese real estate. Once the dominant engine of global wealth, the market there has dropped consistently for the past 36 months straight. In Canada, the average price of a home has fallen for 17 consecutive months. Major metropolitan areas are currently sitting on record high levels of unsold condo inventory. Down in New Zealand, aggressive government interventions have triggered an inflation-adjusted market drop of over a third in some of its major cities. This synchronicity marks a deliberate departure from the previous era of protected property values. Governments are now actively withdrawing the supports that once made real estate a one-way bet. For 20 years, governments everywhere operated under the assumption that they had to step in before house prices fell far enough to cause an economic crisis. Policies were designed to protect the market at all costs. When prices got too high, politicians introduced supposedly helpful affordability measures. They let desperate first-time buyers put 1% down, co-sign with their parents, or raid their retirement savings to scrape together a deposit. This chart shows how demand-side subsidies function. They didn't build more houses. They handed buyers leverage to bid against each other, funneling into higher valuations for existing owners. But that math has broken. The income-to-investor gap means pumping more debt is no longer viable. Because they can no longer subsidize the growing gap, governments are now actively engineering a reversal. They are tearing down the very policies that made housing such a safe bet in the first place. America is officially joining this global pivot. Congress recently passed the 21st Century Road to Housing Act with overwhelming bipartisan margins. Instead of throwing more cash at buyers, this legislation directly targets the supply side of the equation. The first major mechanism acknowledges that local zoning is a national crisis. The federal government will hand out grant money to bribe local city councils into loosening restrictions and allowing for denser construction in single-family neighborhoods. Second, it strips away decades of red tape around factory-built housing. By eliminating outdated rules, like requiring permanent metal chassis, the Department of Housing and Urban Development expects to slash $5,000 to $7,000 off the base production cost of entry-level homes. Finally, the bill implements a hard cap on Wall Street. Any corporate investor that already owns 350 or more single-family homes is permanently banned from buying additional ones, removing the heaviest competitors from the market entirely. Taken together, these policies deliberately dismantle the state-sponsored scarcity that made single-family homes a risk-free, heavily protected investment class for the last 20 years. But Washington is acting relatively late. Policy changes are only half the story. The foundation of the housing market was already buckling under mortgage rates that have effectively tripled from their pandemic lows. There is also a highly localized variable accelerating the decline. Across massive swaths of the American Sunbelt, extreme weather is rendering entire zip codes financially toxic to insure. This chart shows the zero-sum nature of modern mortgage math. To secure a home loan, you need insurance. When an annual premium in Florida or Texas balloons to $8,000, that directly swallows up the cash a family needs to qualify for their monthly mortgage payment. Large institutional investors can clearly see this mathematical wall. In previously booming markets like Dallas, corporate landlords have already become net sellers, dumping their inventory before the correction catches up to them. Government policy is trailing behind the market. This legislation attempts to steer an influx of supply and a collapse in demand that raw economic gravity had already set in motion. Naturally, industry lobbyists are loudly claiming that these corrections will devastate household wealth and drag the broader economy into a systemic collapse. They point to 2008 as proof, but the comparison is entirely flawed. The 2008 collapse was caused by toxic banking debt and reckless securitization that was merely laundered through the housing market. It was not caused by an oversupply of homes. To see what an actual supply-driven correction looks like, look at Denver. The city built enough new housing to give buyers options. Prices fell by 2%, rents dropped, and the local economy is still growing. On a much larger scale, China's property market cratered, wiping out massive development firms like Evergrande. Yet their broader economy continues to grow as they shift capital away from trading empty apartments and into high-end manufacturing. An intentional, supply-driven drop in real estate values doesn't inherently trigger macroeconomic contagion. If a regular good or service becomes cheaper and more abundant, that is an optimal economic outcome. Prices are allowed to just fall. The current housing decline systematically reallocates financial risk away from the state and onto individuals, correcting a multi-decade imbalance. The immediate casualties are recent buyers who purchased at the absolute peak of the market with minimal equity. A moderate price drop leaves them completely underwater on a 6% mortgage. But there is a secondary casualty hidden in the data, the multi-billion-dollar aged care industry, which has become heavily leveraged by private equity buyouts in recent years. Those facilities priced their services on a very specific assumption. They expected a continuous stream of wealthy baby boomers arriving ready to liquidate six-figure, government-protected home equity to fund their stay. When property values fall even moderately, that easy money dries up. The highly leveraged business models of these peripheral industries will break, transferring the financial pain directly into institutional portfolios. For the last 2 decades, treating shelter strictly as a speculative financial instrument yielded massive, consistent returns. But those returns were only possible because the market was artificially shielded by the government. The political cost of unaffordable housing now outweighs the benefits of propping up existing investors. So the state is actively unraveling the safety net. When an investment relies entirely on state protection to guarantee its value, the investor must eventually accept the reality of the state tearing it down.